So as I said, this is my monthly note on M&A for the month of February 2025. The US and the rest of the world are on different paths when it comes to M&A. In the US, it's still very much about artificial intelligence, whereas outside of the US, the focus has been on the materials and financial sector, especially banking. The biggest offer by far in February was Elon Musk's attempted takeover of OpenAI alongside an investor consortium that included Valor Equity Management and Atreides Management. The OpenAI board almost immediately rejected Musk's offer, and Sam Altman famously retorted, as I've noted here, that he'd be happy to buy X or Twitter for a tenth of the price that Musk was offering for OpenAI. That would, of course, be less than a quarter of what Musk paid for it just a couple years ago, which I believe was $44 billion. Although the offer was rejected, we included here because it's not entirely clear yet that Musk is done pursuing OpenAI. And that wasn't the only AI deal in February. xAI sold a minority interest in itself for $10 billion, and Macquarie purchased Align Data Centers, which provides data centers for the use of AI, which Macquarie pointed out. So we believe that the DeepSeek freak out in January was just a momentary blip. Companies are still more than willing to invest in AI. Interestingly, manufacturing and materials deals also had a pretty good month in February, which we view as an indication that companies are still very bullish on infrastructure. Although President Biden hoped to get an election year bump out of his infrastructure bill, that's just not how investments in infrastructure work. The Eisenhower Highways Act paid for road construction that started in 1956. It didn't wind up until 1992. So clearly, Trump is going to benefit from the Biden bipartisan infrastructure bill, as will presidents for the next couple of decades. We also saw a fair number of consumer discretionary deals, and that's notable because it was the third month in a row that we saw elevated levels of consumer discretionary deals, while it was also the third month in a row that the consumer confidence index declined. So clearly, while Americans feel pessimistic about the U.S. economy, corporations are very optimistic. And then I just wrapped up my note, as I do with these two overviews of U.S. and non-U.S. M&A. As I suggested, February was all about technology deals in the U.S., especially AI acquisitions. But if you take tech deals out of the equation, things in M&A land look a lot more bleak. February looks a lot more like some of the worst months of 2023 or 2024. But that being said, we continue to be of the view that technology deals will drive U.S. M&A back to normalcy. We said in an earlier note that U.S. M&A starts the year about 20% below the two-decade average. So M&A has a ways to get back to normal. And global M&A continues its climb out of January, which was one of the worst months in recent memory for global M&A. We continue to see a lot of material sector deals, especially mining acquisitions. We chalk that up to the rise in price for precious metals, gold, silver, copper, platinum, but also the increasing realization that we need those materials not only for coins and jewelry, but to power up the clean energy revolution as well. So that's driving up their rarity and their value. Another interesting trend that we've seen is the number of bank acquisitions in Europe. So, for example, BPER Banca took over Banca Popolare di Sondrio, and that was the 11th Italian bank takeover in the last 12 months. And at the beginning of last year, analysts were guessing that there would be a lot of bank consolidation in Europe, and clearly that's what's taken place, and you can see that certainly in what's happening in Italy. That's all for me today. I hope you enjoy reading the note, and